If you're an early stage Web3 founder, apply to our award-winning accelerator program, Basecamp, at outlierventures.io/Basecamp. We write your first $50,000 check and give you access to 200 mentors, including many of the leading Web3 founders, and a network of 1,000 of the world's leading investors and exchanges. We've helped over 30 startups from 15 countries from all around the world raise $130 million in growth funding and can help you fast-track product market fit and, where relevant, the launch of your token economy. Today, I'm really happy to welcome on Hugh Karp of Nexus Mutual. Welcome, Hugh.
Great to be here, Jamie. Good to be on.
So Nexus is described as people-powered alternative to insurance. You use smart contracts on the Ethereum public chain to allow for discretionary policy cover, which is similar to, but not quite the same as insurance, and we'll unpack that a little bit later. You operate similar to how a mutual insurer might, in that you allow similar users to share risk, in this case, users of DeFi. Where in the past, historically, it might have been, say, farmers or an emerging shipping industry that face very specific forms of risk that the traditional insurance industry would struggle to cover, quantify price and what have you. You do all of this via a specialised legal entity in the UK, and so that allows you to offer a decentralised alternative to the regular insurance industry. So some of the reasons why I've got you on the show. So I'm in the process of forming my thesis at Outlier Ventures on how we collectively as an industry increase institutional adoption of DeFi. And the management of risk seems to be one of those recurring themes when you speak to institutions, the spectrum of institutions, and one of the important blockers. So risk management in crypto, and of course, especially in DeFi, is complex, highly technical, but I guess no different to insuring any other new industry, any other new emergent industry. And as I said, historically, there's lots of precedents of that happening in insurance. So insurance in DeFi, to me, feels like the next critical layer to get added to the DeFi stack. Now, interestingly, Nexus launched way back in 2017, which is light years ago in the context of crypto. Most importantly, before there was a lot of this DeFi hype, and the fact is you're still here, so congratulations on that to start with. You are definitely ahead of the curve, and you've managed to sustain, and from what I can see, to continue to grow and succeed. So I want to understand, how you've made that happen. But also, unusually for DeFi, you also have a professional background in your domain, that of insurance. I believe over 15 years of experience as an actuary. And for context, for listeners, an actuary is somebody who deals with the measurement and management of risk and uncertainty. So looking forward to unpicking, unraveling your founder story, the last 3 years of experience.
Yeah, cool. No, thanks for the introduction. Yeah, it's been a bit of a journey so far, and I guess insurance has always been talked about as one of those things that blockchain technology can actually do really well. And it's always been the originals. I think it was referenced in the original Ethereum kind of when it was launched and stuff. But it's quite challenging to do. So I guess we've been working on it for a while, and especially with DeFi coming up, especially in the past 3 months or something, it's been really good to be there and be able to support that growth as well. And it's obviously been great for Nexus as well.
Yeah, so well done for sticking around, because of course it's not always easy to be right if you're right early, because you then have this huge gap of time which you somehow need to finance to be right and timely. And I think certainly whenever I've heard discussions around blockchain and insurance, it's usually been people in suits talking about how blockchain could, in theory, bring about efficiencies to the existing insurance industry. And I guess with the advent of DeFi, we're actually building up this kind of bottom-up capital market, and therefore you don't have a lot of constraints or legacy things to account for. You can kind of build almost a pure form of perhaps what the end state would be for the existing insurance industry. So it's going to be interesting to see how you as a founder kind of navigate that go-to-market between what is DeFi today and if this stuff becomes more generalizable for the wider insurance industry. So to just give some context to you as a founder, as I said, you've got 15 years in insurance, and you actually studied I don't know how to pronounce that. Actuarial studies, that's a tricky one, from the Australian National University, graduating 2001. You then worked as an actuary in life insurance from 2002 to 2011 at MLC and NAB Wealth. And then you did a 6-year stint at Munich Re, is that right?
Yeah, that's right. Yeah, I moved to London and worked for Munich Re in the UK. For quite a while, and ended up being the CFO for their life operations. So, quite a few different things in the insurance industry.
So that's 2012 to 18. You kind of climbed pretty quickly. So from product development actuary, then head of financial reporting, and then, as you say, CFO for life, UK and Ireland. So you must be good at golf, right? I imagine somebody that climbs that aggressively in the corporate world is good at golf.
Yeah, I'm actually really terrible at golf. Okay. But there are of course all those types of events that the regular insurance industry does. So yeah, lots of deals in pubs and stuff like that. I guess that's how it works. It's a bit old school. It's totally different to how things are working right now. Which is in my mind, it's good.
Yeah, right. Okay, so you must have done that climb based on actual competency then, rather than golf playing abilities and socializing. Then in 2017, you founded Nexus Mutual. You conducted a token sale, right? And you chose. So you're already based in the UK, but I think you've chosen to continue to have Nexus Mutual to be based in the UK. When I was doing some desk research, I knew insurance was big in the UK, but it's, I believe, the 4th largest insurance industry in the world.
London is kind of a historical home of insurance, especially with Lloyd's and everything being built here. So it is a massive market, and obviously close ties into all the other big markets like Bermuda and etc. So it's a hub for insurance knowledge, which is it's a really good place to be for. It's kind of that hybrid approach. Like you've got the expertise and access to the insurance world, but it's also a good blockchain hub as well.
Well, long may that continue. I actually had Prime Minister Bert of Bermuda on the show not too long ago, talking about Bermuda's role in the global ecosystem around reinsurance capital of the world. And as you say, this kind of linkage between the City of London and not to be confused with the kind of metropolis, but the City of London and this kind of wider group of dominions which kind of specialize in capital markets and this kind of offshore system. So if we look at where you are now, as I said, as I'm kind of building out this thesis about what institutional DeFi could look like, increasingly the way that I think and talk about crypto is that we've had this decade of effectively building up a bottom-up capital market kind of sequentially, like layer from money, through to currency, and we've got stable coins, and now we've got lending and borrowing. And so it feels like a natural conclusion or next step that an insurance layer is needed to make that a functioning economy, functioning capital market, and to allow for this financial services industry to grow around it. But was your original starting point to create something initially native to crypto and Web3, or was it to kind of leverage some of the efficiency gains and apply it to the existing insurance world? And did that change or evolve as things like DeFi came about?
Yeah, so we, the original idea was to build and still is to kind of build this kind of generalized platform where you can cover any type of risk. And so we actually started building it for earthquake cover. We did a proof of concept with earthquake cover way back. And then it wasn't very long until we realized the number of people that were in crypto that were likely to use our platform and wanted earthquake cover was very, very small. And so we pivoted. And I think one of the things where triggering that was like, I watched the Dow be drained live. Came into work one day and saw the money coming out, and I was like, okay, wow, like there's some risk here. Then if we're going to be successful, then we're going to need some native cover in the crypto world, and so that's kind of why we pivoted to, and are offering smart contract cover, so to have cover against the hacks in smart contracts. And that's just kind of the start. Our kind of view here, going back to your point, is like it doesn't matter what industry it is, if it's a new industry in whatever form. Like insurance is kind of like fundamental financial infrastructure, and it kind of needs to be there so that people can take risk and do new things. Like nothing's like, it's just boring. Like rocket ships don't get launched or train lines don't get built or whatever. And nothing happens if there's not kind of underlying insurance markets there to kind of take off that risk. So I guess that's what we're trying to provide. And more generally within crypto, like it's very hard to get access to the regular insurance industry because there's just a big knowledge gap and it's quite technical. And sorry, excuse me. And the market's just perhaps not quite big enough yet for the big insurers to put some, research and capability and resources behind it. So it's really good for it works really well for a kind of community-based solution to bootstrap this thing and provide the solutions to begin with.
Yeah. So maybe before we go deeply into understanding risk in DeFi and crypto and the kind of specific offering or constituent parts of Nexus Mutual, it would be good to just do a very quick 101 on insurance and the reinsurance market. I think a lot of people don't necessarily understand the reinsurance market in particular, but also this idea of the mutualization of risk in a kind of historical context.
Yeah, so I mean, insurance companies kind of started way back, hundreds of years, millennia, more, quite a long time, as like just community-based mutuals, essentially. So basically, the community pooled money together, and then someone, usually the elders of the community or something, decided when claim payouts were made, whether that was supporting the worker had lost their life or whatever, supporting the rest of the family, etc., stuff like that. And so, it often developed from like deep within the community. And then as things progressed and developed, then it became more financialized, like standardized. Particular institutions came in to kind of do particular things, like the shipping industry is a good one, where it started with just individuals backing certain risks, and then it became standardized contracts, and then you kind of have a company set up that kind of takes a lot of the risks and backs many of them and diversifies, and then that turns into an insurance company, and etc. So they kind of start like that, and then they kind of transform into like shareholder-based companies. And I think that's probably one important distinction, is like mutual kind of structures are all done for the members, and all that means if there's money left over, then it's owned by the members. Whereas with a shareholder-based company, it's obviously owned by the shareholders, and so you kind of have this. There's a different kind of alignment of interest type issue to think about. So that's kind of how, very briefly, how kind of insurance has progressed over time. And I guess a reinsurance layer, more specifically, is about really insuring the insurance companies. So for usually the more catastrophic events, or to allow them to write more business quite quickly. So those are the two main reasons you would get reinsurers involved. So reinsurers tend to like be B2B type structures, big lots of capital, writing big deals behind the scenes, and they often work for like make sure we get capital efficient structures and things like that. So they're not really well kind of known to the everyday people in the,
and presumably
just because you don't have any interactions with them, but they're
the lack of
big companies
a reinsurer in a nascent industry is one of the constraints about the amount of liability that any one entity can cover, whether that's, I guess, in a crypto DeFi context, a protocol, or a kind of corporate entity. But also, if you think about some of these mutuals, like very prevalent in on the continent in Europe. These are incredibly large financial institutions now. As you say, they might have morphed out of kind of a farmers kind of cooperative or mutual, but now become, almost like a high street insurer. And, what they then do as a player in the capital markets, how they invest money, is also kind of, can you see these entities or protocols becoming beyond the actual act and function of insurance, becoming participants in reinvesting in assets and collateral in the wider ecosystem?
Yeah, potentially. I think that's more of that'll take a while, but I think they'll probably get there eventually. There's quite a few barriers, but like regulatory, can they hold crypto assets or something like that? The regulator kind of has to approve stuff. And then you've also got things like, does it make sense to hold riskier assets on your balance sheet when the main purpose is to hold assets to back claims, and therefore you want more kind of lower yielding but and lower risk assets. So but definitely there's a lot of money sitting there in insurance companies and like mutuals as well as like pension funds and stuff that obviously is not going to enter right now. Is a fair way away, but we need to kind of, as a kind of Web3 industry, kind of start ticking those boxes so that they can come at later points.
As these protocols or organizations in the DeFi space become better collateralized, they might look at how they can deliver yield. We all know kind of the importance of yield in a DeFi context through deploying that capital through different instruments, different mechanisms. So let's talk about Nexus Mutual, how it's structured, its constituent parts. So as I mentioned, there is this governance token, but and as I understand it, a big principle is that it's a non-custodial, right?
Yeah, that's right. I mean, so what we've done is we've tried. The goal is to operate this thing as a DAO, but it's not kind of technically a DAO because I guess there's a spectrum of these things. But the whole idea is it's non-custodial, and the members decide on the key operations of the mutual. So that's they complete actions to kind of price the risk, and they also assess the claims, and they also vote in governance to update parameters or the system if they want to. And so it's definitely non-custodial, run by smart contracts. But I guess the interesting thing about what we're doing is we actually also have a legal entity in the UK. And so the DAO is essentially, the way it's actually structured is you have a membership organisation in the UK, Nexus Mutual Limited, and when you join the DAO, you actually become a member of that company. And that provides essentially it's a kind of a legal wrapper that gives you limited liability on a per member basis, which is quite interesting, and in my opinion has a lot of value. But it also provides some certainty and allows us to contract with the outside non-blockchain world as well, which can be quite useful in certain circumstances. But I guess more broadly, it kind of gives us that legal and regulatory clarity on what we're doing, which is often, especially in DeFi, it's quite challenging right now.
Yeah, so I've heard of DAOs with legal wrappers being referred to as LAOs. I think there is a project called The LAO, but I think it's also more generalizable than that. And I expect it to become an increasing precedent because, as you highlight, if that entity wants to contract, engage, but also remove or reduce the liability for its members, for its participants, then it makes sense to domicile within a particular legal jurisdiction. Otherwise, you're kind of potentially open to action from any legal jurisdiction where a user may reside and interact with the system. And I'm sure you know all about that from a risk perspective. So more for the benefit of the listeners. But it's also interesting, this idea that if you think about a lot of the regulation that exists in the insurance industry to date, it is to ensure a properly functioning insurance market, to protect consumers, users, to ensure, solvency that an insurance firm could pay out if it needed to. And I guess the principle here is that you can do a lot of that through code. So whilst perhaps you don't have that legal regulatory burden because you're not a full-blown insurance company, you're kind of doing this discretionary policy, you in effect can provide greater certainty or comfort to a regulator just by the fact that you're executing on code through smart contracts on a distributed ledger, right?
Yeah, exactly. So, I mean, there's kind of two main angles of why you actually regulate. There's the consumer protection stuff about, does the product do what the product says it does? That's one angle. But the reason you regulate from an insurance point of view is basically because as a customer of an insurance company, you're giving your money to someone else and they are looking after it and making sure that they've got enough to meet the claim payments. So that's kind of the main reason you actually have all this prudential regulation. And so what we're saying is you can actually achieve that much better using code on a public blockchain. So basically, we're non-custodial. You're not actually giving your money to anyone else that has control over it. And so it's all transparent. I guess the other big angle here is, another reason you regulate is to make sure that everyone's got enough solvency and the consumers can be confident that there's like a minimum standard, like all insurance companies will have to be solvent to a certain degree. And so here we're saying, look, we have real-time solvency positions on the entire mutual that anyone can look at any point in time. Whereas in the regular insurance world, it takes you at least 3 months to produce after the year-end date to produce a number to go into the financial statements that then everyone can look at and then the regulator can respond to. And so we're just doing the same thing. We're kind of addressing the same principles about consumer protections and making sure that the money is there, but just in a different way. And so whilst we are regulated because we are a discretionary mutual, we're definitely following the principles about what we should be doing here. And we kind of use capital models that are very equivalent to the regulatory models that get used throughout Europe. And so, we're trying to, that's our approach here, but just do things with the same principles, but just in a different, much more efficient way.
Yeah. And I think if you look at that ability to effectively self-regulate, then that gets really interesting if you were a regulator, because effectively you're beginning to see all the behaviors that you would want in the market with a much lower burden of oversight, direct oversight, to make sure that market's functioning correctly. And, I've been in this space for many years. I've spoken to people in the insurance industry and, very senior people, and they will often tell you, look, to be honest with you, we don't even really know the risk on our books on a real-time basis, just internally, let alone being able to prove that externally. So I think, clearly there are some gains here. So do you see what you're doing as disruptive or transformative to the insurance and reinsurance industry proper?
Yeah, I do. I think we have there's a lot of talk about blockchain being used in the insurance world, but I think we're one of the only ones that are kind of truly trying to disrupt the current model. The other projects are more just using it for like expense efficiency savings using the exact same approach. But here what we're doing is kind of really attacking the kind of core insurance entity and saying, look, we can do this in a much more efficient way now. We can coordinate. I mean, essentially insurance is coordinating a bunch of people to do something with a pool of money and do the right thing with the pool of money. So if you can create the right incentives we have a token to kind of facilitate that. And so if you can create the right incentive structures, then you can do this in a much more efficient way, and you can have it run by the community and hand all the benefits back to the community rather than it, being paid to the shareholders of the regular insurance companies. And not only can you do that, you can do it in a much more consumer-friendly way because everything's fully transparent and stuff. And you can also do it much more efficiently because you gain all of you're basically like a greenfields fully automated insurance company, which you could build using non-blockchain tech, but it's still quite hard to get there.
And so, how does that ecosystem or economy function, I assume there are like a number of roles that need to be carried out in a distributed fashion. Could you just talk us through at a high level, those key function roles that make effectively that game play out effectively and efficiently?
Yeah, so there's four main things you can do within the system. The first one is you can buy cover. So it's like being a simple end user and customer. You kind of select the protocol that you would like cover on. So for example, like Compound or Maker or Uniswap or something. And then you can get a quote and you can purchase cover for a fixed amount in a fixed time period. And that's kind of the usual thing. And then they have some other functions behind that to make sure it all kind of works properly. And I guess the first one would be the risk assessment. And here is where it's essentially the underwriting process or the pricing process. And so what you would do here is, if you want to be a risk assessor, is you can purchase an NXM tokens to start with, and then you stake those NXM tokens against contracts that you think are secure. So for example, you may think Compound is secure, so you can stake some against Compound. And when people do that, the more that's staked, the lower the price of people to purchase cover, and the more capacity or more cover can be offered on Compound. So that's kind of how that one works. It's kind of like, I guess, using prediction market techniques, a bit more structured than a prediction market, but that's kind of the idea behind it. And as a staker, you can earn rewards when people buy cover. There's also downside if there's a claim. So we want to make sure that people back the protocols that they're really interested in, that they're really confident in. And so that's kind of the pricing side. And then we also have the claims assessment side. So anyone in the mutual can also decide to vote in on claims. So when the claims come in, they can also stake some NXM to participate. That's kind of your voting weight. And it's kind of like a weighted average vote. And, there's a few kind of tiers to it in terms of escalation and stuff like that. There's a bit of detail, but the point being is that the members decide as a group on an optional basis. You don't have to vote in claims, but you can. And then they get rewarded like a fee for providing work. And so that's kind of how the claims work. And then the fourth thing to really do is like vote in governance, which is kind of more kind of system level stuff. So, we want to change this parameter or upgrade the contracts to do something else, etc., or add a new product or something. And so any member of the mutual can vote in governance as well.
Yeah, I mean, it's fascinating and clearly a model that's a great fit. I've always felt that a cooperative-like model, in this case, insurance and mutual, would be the kind of predominant form of governance and coordination in these systems. And it's great to see that kind of being played out here. So let's look at risk in DeFi. Could you unpack where you, as a mutual, see risk, what you're currently covering, and what you would like to be able to cover in the future, and how you evaluate and price those risks?
Yeah, sure. So I think I kind of classify risks in DeFi and stuff into three broad categories, and Nexus currently covers just the first one, and we're looking to cover more of them. And so the first one is kind of like the technical smart contract risk. So does the code do what it was intending to do? And so it's very hard to code at like 100% perfect level all the time. And obviously there are audits and stuff like that, but there's always going to be some level of risk on that stuff. So that's kind of our core product right now. And then there are kind of two more groups of two more classifications, and kind of one of them I describe as like external risk to the smart contract. So basically the smart contract works, but there's something outside the smart contract that causes something odd to happen. Whether that's like an oracle that fails, so like a price feed as an example causes something odd to happen, or it could be like a governance attack. So, a lot of these protocols can change parameters or upgrade themselves if the people vote, and potentially someone could buy up a lot of the tokens and attack the system and drain it if they get enough voting power. So like that's kind of an extreme example, but things like that can happen. And the third classification is probably like economic incentives. So a lot of these protocols are built with incentive structures to make sure something works. So for example, the MakerDAO system is designed with an incentive structure so that the DAI peg holds roughly $1. But if the incentives don't work quite right, then it could deviate from a dollar. And so if those are not in balance, then the economic incentives may not work, and so there's a risk there. And so those are the kind of three broad risks, and there's obviously a lot of detail in terms of that, and it's hard to for regular people to kind of work out what's the right thing to do here. How much should I worry about this or not, etc. And so it's important that we can develop insurance products or products we cover like Nexus that can really cover the broader range. And so we're kind of working on expanding the into more comprehensive cover.
Got you. So it'd be great to understand the system as it stands. Who are the users? Who are the participants? What kind of policy agreements are they having covered? I know I heard previously that policies around compound, there's been so much demand, it's oversubscribed. And at what stage and what type of institutional participants will join the system and on its evolution?
Lots of people are interested in cover for basically, I guess, yield purposes. So, the idea being that you put some money into Compound or some other protocol, earn a yield, and then you can buy cover on Nexus and cover the downside risk and get slightly less yield overall, but be in a much better risk reward position. So that's the main idea. And so things like Compound, we got some cover on Compound now, but it has been oversubscribed in the past. We have been growing a lot recently as well, so it does change from time to time. But especially with yield farming kicking off in the last few months, that's been a real a great boon for us, because obviously you can get quite high yields, or you have been able to get very high yields. But who knows what the smart contracts, what the risk is involved, because some of them are just put out there with potentially no audits and et cetera. So, that's been a really good boon for us. In terms of who's buying cover, it actually quite a wide variety of people, like just regular crypto people, but the most cover is actually being bought by smaller institutions, I guess I'd describe them as, hedge funds, or basically people participating in DeFi, earning yields, but they're probably managing other people's money. So they're more risk aware in terms of downside risk than just, I guess, regular people just gambling a little bit of money in DeFi and seeing what will happen. And so that's definitely our main market. Is more the institutions or smaller institution. Institutions is kind of a big bucket of potential, smaller to large. But it's, I think that's more where we're going to be seeing our customer base from, our majority customer base from, because they just tend to be a bit more aware of these things, and it's more of a key requirement for them getting in.
And I assume, centralized exchanges, people engaging with centralized exchanges. I've also heard you talk about how some protocols themselves, and certainly people may be combining what you might refer to as deep DeFi, multi-protocol DeFi, taking out cover as well, right?
Yeah, so we don't do this right now, but some of the things we're working on are stuff where you can cover stacked protocol risk. So, for example, some protocols are built on top of other protocols, all this composability. And if you want to get complete coverage with Nexus, you're going to have to buy a few different covers to cover all that stack. But what we want to do is make it much easier for the regular user, to just get something that covers the whole thing in one go. So we're working on stuff like that. There are other products and other things within DeFi, one thing we can do is potentially provide specific tailored cover for a protocol. And I guess, one example could be that, some protocols have insurance funds, internal insurance funds built off them, and they trigger under certain circumstances. So what we could do is actually link Nexus into that process and go, look, Nexus will take the first, 10 million of cover or something like that. And if something happens, then it injects a claim, and then you don't dip into the insurance fund until that happens, or you can have it the other way around. But, something like that, where you create this tailored product to assist the protocols, because it's interesting, a lot of those protocols will have the final backstop being, we mint more of the native token. And you do that at a point where if you're doing it, it's likely at a point where the token might be a very low value, because there's obviously a serious issue of some description. And so you're kind of minting tokens at the worst possible time. And so you really kind of want to avoid that situation. And so hopefully, Nexus could provide some level of solution for that type of thing.
Yeah, well, I'm thinking, just even with Outlier, we work with 30 startups a year at different levels of the stack, each assuming different degrees of risk. And, this is the kind of thing that I would certainly be recommending all of them should be taking out in one way or the other in order to help them manage risk and give greater surety to users, especially, the closer to the edge they are of innovation, I guess the higher the risk and therefore the higher the requirement. So I can imagine this becoming an expectation of not just institutional investors like venture capital, but increasingly with things like fair launch. Maybe one of the considerations is that, entities take out sufficient cover before they can launch. So let's maybe kind of continue in that theme about expanding where all this could go. So as you said, you function like a DAO, but you're not quite a DAO. I'm assuming if you're not already doing so, you'll be looking to leverage more and more oracles with greater degrees of sophistication. And I don't know if you're also looking at turning insurance contracts into NFTs that could effectively be resold in secondary markets, even used as collateral and earning yield and stuff like that. So of all the innovations you see in Web3, which do you think are going to be most relevant to this maturing insurance reinsurance market on DeFi?
Yeah, I mean, there's a lot of different angles here, I guess. But the first one is we're obviously looking to expand the product set and the different types of risks that we cover. That's kind of step one. It's interesting. There's been on the NFT angle. There's actually been Wire and integration with Nexus has actually effectively done that themselves. And so they've turned Nexus Cover into an NFT that can be traded and sold, and you can buy and sell them on Rarible right now. So that's actually really quite cool. And so we didn't even do that. Andre built it himself. So that's been a really interesting thing, and it kind of, to me, really shows the power of what Web3 can do. You can tokenize stuff that you couldn't tokenize before, and who knows what will happen after that. I kind of think we're doing things that seem intuitively like the next step, right? Or stuff that we've done before, just better from the regular financial world. But there's going to be this whole class of stuff that we haven't been able to do, that we now will be able to do, and we just haven't quite got there yet. And that's what really I think fascinates me. And I guess one of the things is you can tokenize anything in theory, and so how do you then compose all of those together and do new products and new things that they're actually quite fundamentally different to how the regular financial world operates. So I think insurance is part of that. One thing we have been talking about is once you can turn the cover into an NFT, you can actually convert that NFT effectively into slices and create bundled tokens. So you have a yield bearing token, and you create that together, combine it together with the part of the NFT effectively, and you can create a yield bearing covered token that is just a new product that people can move around, but you don't actually have to do anything apart from just purchase a new token, and you've got the covered version. And so stuff like that is really crypto native, that is just impossible to do in any way in the regular financial world right now.
Yeah, I mean, on the one hand, history rhymes, but as you say, at the same time, we're moving into a weird and wonderful space, and because it's a permissionless environment to innovate, and because of the composability, the possibilities are almost limitless. And to be honest with you, I mean, I don't know what your perspective is, but it is easy to talk down on DeFi because of its imperfections, but I see it's almost impossible to discount the industry and where it's going to go, because the rate of innovation, the efficiency that's possible, and therefore the potential for yield to go direct to participants feels almost impossible for the incumbent industry to compete with, right? It's just, I don't know, what's your perspective?
Yeah, I totally agree. I mean, the stuff that's coming out in a week is just phenomenal. And like, even if 90% plus of that fails, some of it will stick and some of it will work. And the speed with which you can do a new financial product or experiment is just so much quicker. It's like, if it can take you 2 years or more to come up with a new financial product in the regular financial world. Whereas here you can spin it up in, a few days if you've got some coding knowledge and just trial it at a really low level and iterate on it. And that has to lead to new things. And it has to lead to, it's just the speed's going to, it will eat regular finance, in my opinion. It's just a matter of time. And so I think that type of approach, I mean, there's obviously downsides to it because, there can be scams and things that don't work and experiments will fail and all the rest of it. But I think underlying the fundamental principles are really powerful. And I believe that it's just going to keep growing and be more successful.
Yeah, I mean, I think the net benefit, as you say, if you subtract any of the malpractice that goes on whilst the industry is relatively nascent, and then you look at the net benefit over the next decade, and because the fact that you can have greater assurances around auditability and solvency and everything else, all the things that ultimately regulators are there to make happen, it almost feels irresistible. And of course, insurance itself is an enabler for that innovation to happen. It's a way of managing that risk. Hugh, it's been great having you on. I'm really excited to look at the possibilities of Nexus, and as you say, how people then take what you're doing and apply it into wrap it up and apply it and mint new things and NFTs and stuff. It's going to be fascinating to watch. So thanks for coming on the show, and good luck with everything.
Cool. Thank you very much. It's been great to chat.
If you enjoyed today's podcast, please make sure you subscribe, rate, and share your feedback to help us reach as many people as possible with the important mission of Web3.